OFS and IPO. In the secondary market, promoters of the company might still want additional capital, for which there are three options available: rights issue, offer for sale, and follow-on public offer. We have already covered concept of right issue in previous videos. OFS. The promoter can choose to offer the secondary issue of shares to the whole market, unlike a rights issue which is restricted to existing shareholders. The exchange provides a separate window through the stockbrokers for the offer for sale. The exchange allows company to route funds through OFS only if the promoters want to sell out their holdings and to maintain minimum public shareholding requirement. For example, government PSU have a public shareholding requirement of 25%. There is a floor price set by the company at or above which bids can be made by both retail and non-retail investors. The shares are allotted if bids are at cutoff price or above will be settled by the exchange into the investor demat account in T+1 days. An example of an offer for sale is NTPC Limited, which offered a maximum of 46.35 million shares at a floor price of Rs 168 and was fully subscribed in the second day period. The OFS was held on 29th August 2017 for non-retail investors and 30th August 2017 for retail investors. FPO. A FPO also has the same intent of raising additional capital after it has been listed, but follows a different mechanism for the application and allotment of shares. Shares can be diluted and fresh shares can be created and offered in a FPO. Just like an IPO, a FPO requires that merchant bankers be appointed to create a draft trade hearing prospectus (DRHP), which has to be approved by SEBI, after which bidding is allowed in a 3 to 5 days period. Investors can place their bids through ASBA and shares are allotted based on the cutoff price decided after the book building process. Since the introduction of OFS in 2012, FPOs are seldom used due to the lengthy process of approvals. The company decides on a price band and the FPO is publicly advertised. Prospective investors can bid for the issue using ASBA portal through internet banking or apply through a bank branch. After the bidding process is complete, the cutoff price is declared based on the demand and the additional shares allotted are listed on the exchange for trading in the secondary markets. An example of an FPO is of Engineers India Limited, which underwent an issue in February 2014 with a price band of Rs 145 to 150. The issue was oversubscribed by 3 times. The shares on the day of starting date of the issue was trading at Rs 151. The lower price band was at 4.2% discount from the market price. Difference between OFS and FPO. An OFS is used to offload the shares of promoters, while a FPO is used to fund new projects. Dilution of shares is allowed in an FPO, leading to change in shareholding structure, while OFS does not affect the number of authorized shares. Only the top 200 companies by market capitalization are allowed to use OFS route to raise funds, while FPO option can be used by all listed companies. Ever since OFS has been introduced by SEBI, FPO issues have come down and companies prefer to choose the OFS route to raise funds.